throughout this decade, gold is going to hit above 3,000 an ounce. It's not even a question.
Okay, so I won't add a big lead into this one because it's already going to run long, but to give you an idea of what you'll find, Lior Gantz is going to answer some questions on upcoming performance of gold and silver, and he's also going to cover the reasons for the performance and then give some of his guesses at the ranges and the timelines. Now, I say ranges because Lior is suggesting that we're going to see a drop, and really a drop in all markets, and he thinks that we're going to see that relatively soon. Now, Lior is also going to give his thoughts on how low gold could go, and then, as you saw in the intro, how high it should proceed to go as well. He's also going to give the timelines for when he thinks all of this is going to happen. Now, there's a lot more in here, so I think we just jump in, but I am cutting you part way in, so to give you just a heads up, Lior Gantz, he has been on the channel a few times, but if you want to find out more about him, I'm going to drop his link in a few times, but it's wealthresearchgroup.com. Let's start with the Fed and how their stance is affecting the markets. But since this is a precious metals channel, maybe we can jump forward a little bit to like the eventual Fed pivot and what happens to gold and silver once the Fed changes from hawk to dove.
Sure. And just for context, we're doing the interview on before the Fed meeting, and this will be, when you watch it, it will be after the Fed meeting. So assuming that what the Fed does is what the market expects it to do, which is raise by 0.75 or 75 basis points to 3% on the Fed fund rate, most likely a lot of it is already priced in. What you're asking is, when will the Fed, or what will cause the Fed to start trickling back? So instead of 75 basis points, maybe 50, maybe 25, maybe nothing. What's going to change their minds? And we have to go back to the Jackson Hole speech. In the Jackson Hole speech, basically Powell lays out his plan. And he says there's three parts to the plan. One, we cannot repeat the mistakes of the 1970s. And what happened in the mid-1970s? The Fed thought it had inflation under control. It started to ease, and then inflation erupted anew in the mid-70s. They are aware of it, and they don't want that to happen. Second thing that they're watching is what's called inflationary expectations. That's when the University of Michigan and other major surveys that are really accurate for consumer sentiment, small and mid-sized businesses, sentiment, economists, lobbyists, etc., and then also the markets, they're looking at inflationary expectations. If they become what they call unanchored, which means that you and I, instead of discussing how we're going to grow our business, we're discussing how we're going to raise our prices. That is what's called unanchored inflationary expectations. Luckily, right now, inflation expectations are really anchored. In other words, the consumer is starting to say, okay, I cannot afford houses anymore. That means my neighbor can't afford the house anymore. That means he can't afford the house. And so we're definitely deflating in the real estate market. That is anchoring inflationary expectations down. Well, secondly, if I can afford a car, if I can afford a vacation, if I'm going to trickle back, he's trickling back, etc., then this becomes very anchored. And that's what I think is happening right now. They don't want to lose that. They don't want people to start thinking inflation again. Obviously, everyone's talking about inflation, but nobody's really panicking right now to a disproportionate degree. You don't see across America scenarios of hyperinflation mentality. So that's second, and that's really important. If that doesn't change, that really helps us avoid a Paul Volcker type emergency rate hike. And the third thing is they want to make sure, make sure the job is done. And what that means is I explained it to like my 6-year-old crushing a little bug. Like with one foul swoop, I mean, the bug is dead, but she will pound it like a few more times because she's in panic over it, and she wants to make sure it's not with us anymore. That's what they will do with inflation, and that's why I think, and my analysis points to the end of the zero interest rates era. It doesn't mean that they won't ever go back to being dovish during this business cycle, but it means that I think that they will talk about being dovish for a long time before they actually act on that dovishness. If you look at my name here, it's wealthresearchgroup.com/ZERP, and it's because we believe that the end of zero interest rate policies are upon us, and that we will stay likely in these levels of interest rates for many more years before they actually become truly dovish. So I do suggest if people want to study this further and really understand how this really affects everything, download that report and definitely check it out over the weekend. Read it, study it, understand the potential of what's going to happen.
Give us an idea of where you think that pivot comes. Is it 4%? Is it something I haven't thought of? Is there an idea? Is there a best guess of where it is, or are we still watching the numbers to see?
Okay, so we are in a real reset of the global economy. The reset is an interest rate environment reset. And when you have a reset, you have a lot of uncertainty. Just to give you an idea, and in a reset, things go really bent out of shape, like things that are unsustainable, not normal. They all happen during a reset, because in a reset, we're all like shuffling and nobody knows where we end, right? In a recession, it's easier to think where this ends. We have a classical recession numbers, like we know, median unemployment numbers. We know how much the markets tend to fall in recessions. We know how long they last. We have all this data about recessions. They're easier to build a portfolio around, to build your life around. They definitely hurt and they're painful. But resets are different. You're like shuffling, and you don't know when it's over. There's no textbook for a reset. So all these crazy things can happen during a reset. So what I'm trying to tell you is, it's so uncertain that we don't know. And that's why the Fed tells you we are data dependent. And I am also, therefore, by derivative, data dependent. In other words, when the Fed speaks, it starts to move the markets even before they actually do anything. If they say tomorrow or on Wednesday at that meeting, hey, we're thinking about 6% interest rates, that's going to move markets even before they do anything. And so what they mean by data dependent is that they'll keep signaling what they want, and what they want is a softer landing as possible. We're already on the way down, so it's already not nice. Nobody thinks this is a soft year, so it's just how hard this landing would be. So what they're trying to do is set expectations, and setting expectations is the best way to not shock markets. But they have no idea how you and I and all these other billions of people around the world will act. If we keep acting in a way that's inflationary, if supply chains don't work, if we're not smoothly operating, if Russia and Ukraine go been out of shape, if there's a problem in Taiwan, etc., these are all things that will impact what they do. Therefore, this reset is really uncertain. In my opinion, what they will look at and keep looking at is where the markets are pricing interest rates, and they will likely try to match market expectations as much as possible. Right now, the markets expect 4.5%. That's a very, very long way to go. So, because we're only at 2.25. So let's say they raise interest rates to the 3, we're still a long ways away. In my opinion, right now, that's our best guess, that the Fed funds rate is going all the way to 4, perhaps even 4.5%. And then my analysis, which is different than the consensus, is that they don't immediately pivot, that they wait there and confirm that the job is done. So kind of to marry this into precious metals, which was your original question, I think right now you need to have 2 hats on. One hat is, do I have enough physical or do I not? If I have enough physical, just keep the physical that you have. You don't need to sell it. You don't need to buy more. You can just hold, because you have enough according to your goals. If you don't have enough, you can buy more ounces for less money. So that's the physical debate that you should have. If you're in this not to accumulate more and more ounces into your life, but to trade, in other words, buy low, sell high, commodities, classic trading, then I think that you have time. In other words, you can nibble and buy small positions, but the trend is definitely against you right now with gold, and certainly to a large degree in silver, not only because of interest rates, but because of the strength of the dollar as well.
A couple things. Clearly, you're talking about going long on gold, and really in that case, it doesn't matter if it's physical or if it's some kind of equity, some kind of miner, whatever it is. The idea is that you're buying now, you're not selling anytime soon. So that part I think everybody gets. I think there's still that question of like, what signals a change? I'm talking gold because I think gold and silver have different fundamentals and they react differently. But what changes gold price trend from bear to bull?
So that's a great question, and the answer is that what's happening now is very similar to what happened between 2009 and 2011. In 2009 to 2011, the Fed was reacting aggressively to a crisis. During that time, the markets were thinking reflation. In other words, everyone was like, oh, this is going to reflate. We're going to go to 10, 20, 30% inflation. There were talks about silver to 150, gold going. Okay. And we react. Silver went from 9 to 49. Gold went from 850 to 1900 plus. But then by 2011, the markets start to realize that when central banks create money and that or credit or currency, and that currency goes into the commercial banks, and those commercial banks do not lend it to the main economy, then you do not have inflation. You simply have excess credit in the economy, and that actually is very deflationary. Once that realization came to be, we started a trend from 2011 until the pandemic, which was strong tech and low interest rates and muted inflation. We are right now in the exact opposite of it. In other words, the real trend is inflation, just like as the real trend in 2008-9 was deflation. The Fed came in to solve the crisis. So the markets now believe deflation. They believe that the Fed is going to win this. Once the realization comes that the Fed cannot sustain its goal of 2% interest rates, of 2% inflation, that you won't be able to get CPI down. Once they realize that no matter what they do, they will not be able to counteract the very inflationary trends that we have currently in our world, namely deglobalization, the insane amount of millennials that are getting married, forming families, and need a new home, and supply chain shocks throughout the world, and the energy crisis in Europe. Once they realize, on top of that, ESG and compliance and regulation over mining and commodities, once they realize these are so big that it doesn't matter what they do, that's the decade that's in front of us. Once the market realizes that, then you'll have a major pivot in gold. And throughout this decade, gold is going to hit above 3,000 an ounce. It's not even a question. The question is just how close to the bottom are you going to be able to buy a big position? In other words, can you buy the dips smartly? And then how are you going to ride out the gains? Because our analysis shows that this is going to be an ultra inflationary decade, no matter what the market currently thinks, because the market is very wrong, just like it was in 2009 to 11, that what the Fed is doing right now is going to lead into sustainable, long-lasting results. It won't. It's just trying to contain inflation, but inflation is actually the trend that's going to rule this decade. So, in my opinion, that magic moment, we just don't know when it is. But in my opinion, it will be between now and the end of 2023. Gold will bottom, will create an incredible bottom, and then in my opinion, it is going over 3,000.
What do you think that bottom would be like if you were just going to guess?
So I would say it's going to be between the 1500s and the 1400s.
Really?
Yeah.
1400s.
Yeah. Yeah. If you remember September of 2018, the last time I bought physical gold, uh, um, gold went to 1180 on the day, and I bought ounces at 1200 an ounce, and that was the last bottom. It's not that hard to um, to understand when gold bottoms. It has a major puke day that you're like, wow, this is insane. This is $100 down day in a few minutes. It has like a true re-rating where it flushes out and wipes out any traders, any speculators, anything, and just you're like in shock. So you wait for those days, for one or two of those days, and that's probably your bottom. It comes near a major pivot in something, and then that's it. So in my opinion, it will be somewhere in those low 1400s.
So then, and you were thinking that that's as soon as the end of 2023?
Yeah, if you were to kind of narrow it down further, I think it will happen in Q1 of 2023, but there's no telling. In my opinion, gold bottoms between now and the end of March 2023.
Okay, and we're just speculating here. Nothing's we're not going to hold it against you if you're off on that. I just am curious, kind of in your thinking, because earlier you said if you have enough ounces, hold, or just kind of cherry pick, buy here and there. I mean, some of that's just good habit to be buying as you go rather than waiting, and it's a lot easier to buy in bits to dollar cost average, I guess is where I'm going with that. But then you said 3,000 also. So you're expecting pretty big moves for a market that's pretty tame. Gold it's not very volatile. You're thinking down as far as the 1400s, and you said 1400s or 1500s, and then bouncing to 3. What do you think on that bounce to 3? Is that over the course of many years, or is that a quick move as well?
Gold has all of the right trends behind it to break that all-time high of 2069 and change that it went on in August of 2020 and rise way above that. If you look at the historical rate of return on gold per year since 1971, it's been 6.6%. Nothing that I'm forecasting deviates from that trend line. During the 21st century, we've gone from 250 gold to about 2,000 gold in 20 years. So that's an 8-fold or 700% move, which is better than what the S&P 500 and the NASDAQ have done since January 1st of 2000. So gold has outperformed stocks during this millennia. I think that what you will see in the coming years, in the coming few months, is you will see gold bottoming likely with the markets. In other words, the NASDAQ and the S&P 500 will form their bottom for this bear market, and gold will probably follow suit and either lead or follow them. But we're talking mere days. They will all correlate to form the reset bottom, because we're in a reset. We're in an interest rate environment reset. So we're raising interest rates. Everything is coming down in price until that point where enough is enough for the markets. It's that magical moment. Nobody knows what it is, but history says we have gone through 80% of the move. So if that's correct, we will have our bottom. And if you look at historical bottoms for gold, to say that gold will double from a major bottom is not far-fetched at all. If you're looking at a timeline, I would say to look at gold as compounding after a bottom at about a 25% per year clip for about 4 years on average, In other words, between now and 2026, we reach 3,000. I would say that's a very realistic way to look at it. And at gold 3,000, just we're all on the same page. Silver will likely hit the 50s or the 60s by 2026. So, because we see a 50-to-1 ratio. Also, keep in mind the dollar right now is in a I would say a generational reset. It's stronger than the euro. It's at a 22-year high on the DXY. It's mimicking the strength it had before the Plaza Accord in 1985, when actually the G7 meeting, which will meet in Bali in November, had to intervene because it was crushing emerging markets. I think we are very similar in that scenario. So I see the dollar after it peaks here having a really terrible bear market after almost 13 years of a bull market that we started in 2011. If that's the case, in real terms, I think that DXY is going from about 120 to 80. That's a 33% move down. That's huge. That's massive. And that correlates with my theme of very high prices for gold and silver in the next 4 years.
Fantastic. So thank you again, Lior. Always good to talk to you.
Thank you, sir.